Hello and welcome. You're watching KYC. Today we have an interesting company for you. It's in the wiring segment and it makes steel wires. Now what I want to know about Bansal Wire Industries is that they follow a cost plus model. So how powerful is that? Because you are basically going away from any raw material cost inflation which might eat into your numbers and your margins. Is this a sustainable model? One. Second, is there still some bit of risk, if any, from raw material pricing? If there is an inch up in raw material pricing, does that dilute your margins? That's what I want to understand. And how much of that is built in to your contracts with your customers. So a little bit around that, I believe that could well be a risk because the margins are single digit, mind you. Any piece of that hurting margins could well hurt the numbers in significant fashion. We haven't seen it yet in the last 4 years that we've looked at the data for, but it could happen. And that's what I want to understand, what the risk of that is. The second one is the geopolitical risk. Everything that's playing out in markets currently has the geopolitical risk if you are export facing. Bansal Wire does do exports and therefore could that be a very real risk is what I'd want to understand. The third one is their FY26 strategy. Now this is where it starts getting very interesting. Now Bansal Wire Industries has suggested that FY26 will be a tough year, it will be a muted year. And while volume growth will be the focus, margins will not expand. And therefore, they are saying that we will keep this year more focused on market share acquisition. Can that, in a significant fashion, really aid market share and aid the FY27 numbers? Can this strategy play out? What is the downside risk of this strategy? And what is the rationale behind it is what I'd want to understand. Now, product mix. Post this strategy push, is there a change in product mix? And I want to understand this because the margins on each of the products is very different. And that's where, again, it's fascinating because you could well push one product with a higher margin, which could lead to a substantially different margin picture, FY27 and beyond. And therefore, profits will just be in another orbit if that were to happen. I want to understand whether that upside possibility is there. Now, FY27, therefore, what should we expect overall, both in terms of top line growth, margins, volumes, and what will backward integration really bring? Because they're going into backward integration and they're saying that that cost control should aid the numbers going forward. But how much of that, how much do raw material prices stop mattering? And how much, therefore, does that give or lend to margins? So a lot of these questions is what I want to understand and try and break down. Let me first start off with what Bansal Wire Industries does. It's a manufacturer of steel wires. I did indicate that. It's the largest stainless steel wire manufacturer in India. It's the second largest steel wire manufacturer in India. The products cater to diverse industries, automotive, infra, even aero for that matter. And general engineering, really. So it's a diverse set, and we'll talk a little bit about industry-wide as well as to how the split in terms of revenue across industries is looking. It's fairly diverse, and that will give you a better understanding. But it's setting up a stainless steel manufacturing facility for wire rod manufacturing. Now, this could be, again, one of those business changes which could aid the numbers significantly going forward. So you want to look out for all of these. But let's first talk about the journey of the company. It was incorporated in 1985. In 1995, it added the stainless steel wire production line. It also commenced the manufacturing of galvanized wire in 2003. 2007 commenced high carbon wires production. Now, I'll explain what each of these products is, but for now, we're just going through the journey. The products in automotive industry was started in 2015. 2022, it commenced the infra for the Dadri plant, which is significant expansion. It acquired Bansal Steel and Power in 2023, IPO'd in 2024, and in 2025, January, we have the Dadri facility which has commenced operations. Now, I want to talk to you a little bit about the products because, you know, what exactly is steel wires, right? And where is it used? So there are three types of steel wires that Bansal Wire Industries manufactures. The first one is high carbon steel. This is extremely strong steel. It has a very high carbon component in the steel wire. It's the stronger option where steel wires are concerned. So whenever a steel wire ought to be used, say for example for a bridge, right? You would want something which has very high durability and very high strength. This is where you use a higher carbon within your steel wiring, which is what high carbon steel wiring is. This also, in terms of pricing, happens to be the most expensive of the steel wires that you have. So again, something to keep in mind. We'll also look at the EBITDA and the possible margins on each of these products. But first off, let's understand the other two. You have mild steel wire, which is a lower carbon within the steel wire complex. There's a lower carbon component and therefore it's slightly weaker than the high carbon option that you have. It is used where lower stress is required. It could be certain components within the auto space where you require lower stress, but at the same time you require steel wiring. So maybe that is one place of use. The last one is stainless steel wiring. This is corrosion resistant, and this becomes important because steel in general will corrode, but stainless steel will not. And again, you will have more versatile uses for a stainless steel wire than a mild steel or a high carbon steel. So all three very different uses, and at the same time you have these three products across categories. Now let's talk about the pricing here. And again, this stands out. Okay, so first let's talk revenue. Look at the diversity of the revenue, of the total cumulative revenue pie that there is. There's auto, which is 9%. Then there is general engineering, which is 12%. There is 19% in consumer durables. So you have a fairly large mix and a fairly wide 19%, I beg your pardon, in auto. General engineering is 12, infra is 11, hardware is 9, durable is 9, power transmission is 6, agri is 5, and then you have other component. This is as per a DAM capital report, so I want to quickly caveat that as well. Now let me talk about the EBITDA per ton for each of the products that they manufacture. This is the EBITDA per ton, so very high for high carbon, 11,000 rupees per ton, 4,500 for low carbon. Stainless steel is 7,000 rupees per ton. So that's the EBITDA per ton. And if you're looking at the margins as well, the margins are sitting at 14% for high carbon, low carbon is 6.3, and stainless steel is just 4.5. So again, that's something you want to look out for. There's backward integration happening, and we spoke about this a little bit. There's a 1.8 lakh ton induction-based steel plant, 60,000 tons of low carbon and stainless steel wire manufacturing capacity is going to come up. And you have with steel which is going to be made from scrapped steel. So there's going to be smelting, or rather melting and casting, which is going to happen of scrapped steel, which is going to be used for the purpose of production of steel wires. Also, they're producing wire rods from the newly made steel. This will be commissioned only in FY28, and it increases stainless steel wires EBITDA by rupees 4,000 to rupees 5,000 per ton. Mind you, the stainless steel wires EBITDA per ton is 7,000. So this could well be a large inflection for the stainless steel part of the business. And this is where you want to also tie up what I mentioned earlier, the product mix. Because if the product mix were to evolve by FY28, then you have this very large stainless steel capacity, plus you have stainless steel EBITDA per ton going up. Both of those could well lead the numbers higher, FY27 of course, but FY28 as well. So all of this is what we'll try to quiz management on, because a lot of this is forward guidance. But let's talk about the metrics first. The metrics with regard to a Bansal Wire Industries, I'm going to start off with the income statement, the balance sheet, the cash flow, the return ratios. Thereafter, we look at shareholding, street cred, valuations, and street coverage. We look at all of the 8 parameters, and we'll assess and judge where it fits on our KYC ratings. Let's start off with the income statement. You're looking at the 3-year top line, which is compounded at 17%. Not bad at all, 17% CAGR. And mind you, it was unlisted for 2 out of those 3 years, right? So it's listed only for the last less than 12-month period. So you want to, again, keep that in mind because there's good growth even during the unlisted period of the share. Let's talk also a little bit about the EBITDA. The EBITDA is up 36% on the 3-year CAGR basis. A large part of that came in FY25. Your margins have gone up from 4-5% 6% in FY24 and 8% in FY25, nearly 8%. I'd say 7.7% to be absolutely precise. Let's talk about net profit as well. 37% growth. That's what's driving PAT growth. The EBITDA is driving it. 37% up, 3-year CAGR. So again, strong growth in terms of profitability as well. A lot of it back-ended, mind you, in FY25. You look at that margin jump, a lot of it has come in FY25, something you want to be cautious about, but it's a strong growth nonetheless. So, so a thumbs up with regard to where your margin as well as your top line picture goes in terms of growth. Let's talk about the balance sheet now. The equity share capital has gone up. It went up in FY24 pre the IPO. It went up FY25 as well post the IPO. Now you have the book value sitting at 1,268 odd crore, but you look at the borrowing has gone up. The borrowing has gone up, or rather currently sits at around 500 crore. When I'm talking about short-term plus long-term borrowing. So both of those numbers are currently sitting at nearly 500 crore. Something you want to keep in mind when you're looking at a company of this size, that the debt to equity has gone up. Yes, they're doing capex, but the debt to equity has gone up. You want to be careful at this point with regard to a company like that. Let's talk about cash flow now. The cash flow, again, very interesting picture. The cash flow from operations has actually turned negative in FY25. And 2 factors I'll quickly list down as to why that is so. One, you have your receivables which have gone up substantially, and I'll enumerate that for you. 21 crore negative is the impact of receivables on cash flow from operations. Receivables have gone up FY23 versus FY24 by 21 crore and then by 173 crore between FY24 and FY25. Inventory as well from negative 11 has gone up, in FY24 has gone up by around 11 crore and then in FY25 has gone up by 224 crore. I want to understand as to why that is so and whether that unwind on both receivables as well as inventory happens in the current financial year, which is FY26. And therefore, that negative working capital change in FY25 has gone up by 280 crore nearly, which is what is impacting your cash flow number in a significant fashion. So that's why you're seeing that negative 100 crore cash flow from operations, which is sitting in your cash flow. Your profit after tax, though, has gone up decently. It's at 269 crore. Your net cash flow not as relevant because you had all these fundraisers, you had these debt repayments, and you also have new debt which you have raised and the capex that you're doing. So all of that has gone into the net cash flow, which is currently nil or whatever, very, very small, both in FY23 and 24 as well. So not as relevant for such a high capex kind of business. Let's talk about return ratios now. Again, when you're looking at the return ratios, it's largely been steady, 14 to 16 odd %. That's good, right? That's positive. But can I go towards 20% from here, or will I maintain that 15% kind of number? 15% checks the box, there's no doubt about it. But can I go higher is the question as I scale up. So that's a question which we will try and understand, and that may not happen this year or maybe even next year. But could it happen in FY27 or 28 is really the question. So we'll have to wait and watch on that. Let's talk about shareholding now. You're looking at 78% of the shareholding held by promoters. Mind you, this company listed in July of 2024. So I don't have a large comparable in terms of the holding for promoters earlier versus now. Are they diluting stake? Well, none of that. They will have to dilute stake to a certain extent, and their lock-in completely expires in January of 2026. That's one date you want to keep in mind. When lock-in expires, you will see promoters dilute, likely at least a little bit. They'll be forced to dilute because they have to dilute to 75% at the very least. What they do thereafter will be the question. But for the moment, there's a decent promoter holding at least already built in. So again, that's something you want to keep in mind. And look at the DII holding as well. Invesco India Manufacturing Fund holds around 3.6% in this company. That's the other piece that's standing out. Not too much public interest. That's the other thing that's standing out. So 3-4 pieces which are looking quite positive where shareholding is concerned. Now let's talk about street cred. And again, this is a tricky one because there's just 9 months of data available to me, right? So let's look at the IPO price. It was 256. Currently, the stock is at 370 rupees a piece. So plenty of value left on the table by promoters. Again, that's a thumbs up. I would treat that as a thumbs up. While the year-to-date returns are difficult, and since the listing as well, it listed at 356, so substantial value unwind happened there itself. But it currently has given only an 8% return to investors post if you have been a buyer from the listing date. So that not looking too good. But I would rate this more from a promoter perspective that they've left plenty of value on the table for investors, and we look at the valuations as well because that will also give us a decent indication of this. So once I've put that out of the way, now let's talk a little bit about valuations itself. Now you look at the EPS estimates. This is the average EPS estimate by analysts, 10.8 and 16. That brings the FY26 expected price to earnings at 35 times currently, and price to earnings FY27 at 23.5 times. The IPO valuation suggested 26.5 times 1 year forward, which was FY25 valuations. It listed in 2024 July, and therefore when I'm looking at FY25 valuations, it was trading at around 26 times basis the 250 rupees price that they listed at. So that's one thing that I have my eye on, and therefore your valuations don't leave too much room for positive surprise, and therefore we're giving this a neutral unless the numbers change, of course, and that will be something that we will ask and quiz management on. Let's look at analyst recommendations. There are 3 buy calls, no hold, no sell, potential upside 22%. So very, very strong upside that we are seeing on this, but just 3 analysts. 1 has not rated it, but 3 otherwise have rated it a buy, and a 22% upside is what they are seeing. Let's quickly go through the ratings, therefore. Let's sum it up. Let's put it all together. Revenue, revenue is a thumbs up, income statement. Balance sheet, cash flow, return ratios, that's how it stacks up. Shareholding, street cred, valuation, street coverage. And that gives us a 4.5 out of 8 on our KYC rating for Bansal Wire Industries. Let's go across to Pranav Bansal, CEO and MD at Bansal Wire Industries, to talk to us about how he sees the business and what to expect going forward. Good morning, Pranav. Pranav, I want to start off by understanding from you as to how much of a correlation or impact does raw material price increases have on your business? How sustainable is the cost plus model that you adopt? How much of this is built into agreements is what I want to understand.
Yeah, hi. So, in the last 85 years of our business, I am the 3rd generation now of my family in this business. And all along, we have tried to maintain a cost plus model in our industry because raw material accounts for a major part of our total cost. And we have done a lot of diversification strategy in our suppliers, wherein we are always able to maintain, kind of flexibility there, and which you will see in our past as well. But no matter how raw material has behaved, we have kept an intact margin.
That, Pranav, give us some understanding, some color.
Can you say that again?
How have you managed to do that? Is it on the basis of some agreements that you have with your customers which allows you to adjust for price? How does that work?
So yes, of course. We have a cost plus model where in any raw material increase and decrease that we get, we are able to pass it on to majority of our customers within a month or so. And apart from this, we have also widened our supplier base. So therefore, we are also able to do a long-term contract with our suppliers for pricing. to maintain it on a stable side.
By majority, do you mean 80%, 70%, 51%? Just give us a number in terms of what that number would be. How much or how many contracts would you have in terms of where you're allowed to pass it on right away within 1 month?
So at least 85% of our sales happen in customers wherein we are able to pass on our increase and decrease within a month.
And what's the current geopolitical risk looking like? You also do exports. Does that put a dent on FY26 numbers at all, given everything that's happening with regard to geopolitics? And how are freight costs evolving? Because you also are impacted by that.
Definitely. So as a strategy, we have always tried to diversify as much as possible. Even in exports, we export to about 60 plus countries. Although our major share of export is in the US and Europe, and those two economies have not given us a very good number in the last 2-3 years. But as a whole, because export is about 10 to 15% of our total revenue, so that does not really impact us at a large scale. There has definitely been a slowdown in our export sales in the last 2 years. But even after that, we've been able to keep our numbers growing and our margins intact. Freight cost is definitely another aspect that we have struggled with in the last couple of years. But most of our contracts are where prices are X our manufacturing facility. So freight cost does not really impact our margins, but it definitely is a factor that comes into play when we are trying to bid for new products.
Pranav, if exports were to turn around, and I'm trying to understand upsides here, if exports were to turn around, you've said US, Europe has not contributed well for you, both margin-wise and top-line-wise. What are the factors which will help it turn around? And two, how quickly can it turn around, if at all, and how will it contribute?
So, as I said before, as a strategy, we have tried to diversify as much as possible. So, if we are in a situation where if export doesn't do well, it does not impact us a lot. Similarly, if export really does a lot better, still in total, it will not be a big part or big contributor to our growth. We are a company that is based on the domestic market. 85, 90% of our sales happen within India, and that's where our focus lies.
Okay.
Because it already has tremendous opportunities for us.
Point taken. FY26, Pranav, what's the outlook like? You're going to sacrifice margins. Therefore, where should that margin number lie? And what's the thought process behind the strategy?
Sure. So even in the last 20, 25 years, if you look at our numbers, as a company, we've grown at 20, 25% on an average. There have been years in which we've grown at 10%, and there have been years in which we've grown at 30%. But on an average, we keep on growing at 20 to 25%. And that's our thought process even for the future. So next year, we have targeted this to be a year where we will grab volumes. And to do that, we might have to sacrifice some margins. Plus, there will be a bit of a margin decrease because of product mix changing as well. So we are looking at about 15 to 20% kind of a overall margin drop, in which most of it is also coming from the product mix that is changing.
And what's the thought process beyond that? So you're changing product mix. Will you do more of stainless steel? Am I understanding that right? And does that give you a leg up from FY28 onwards? Is that what you're thinking about? Saying that stainless steel from FY28 will have EBITDA per ton, which is far higher, and therefore might as well focus more on that. Is that the thought process?
Yes, definitely. You actually got it absolutely right. So stainless steel and low carbon as a product, we have not increased in this year. High carbon is the segment which increased rapidly. This is the reason why our EBITDA per ton on a blended basis also increased in this financial year. Next financial year, our focus will be more on stainless steel and low carbon wax, because after our backward integration initiatives, our margins in the other two products will also increase. So we want to focus on those two segments more.
Okay.
And today, all we are concerned with is absolute EBITDA. So even if our margin per ton goes up or goes down, does not really matter as long as we are able to get an absolute increase in EBITDA.
Pranav, I'm going to quickly ask you for three pieces. First, on the top line, what's the growth looking like in terms of CAGR for the next 3 years?
So as I said, as a company, we want to grow at 20 to 25%. So on an average, we want to continue growing at 20.
So you likely double in terms of top line by FY28. That's the thought process. Okay. Where does EBITDA therefore go? Because you're looking at a better EBITDA per ton and product mix change. So where does that EBITDA number go? Should it grow at 30+%?
So EBITDA would actually not grow at 30% for the next year for FY26 or 27.
Sure.
But yes, from FY28 with the backward integration kicking in, and with that also our foray into specialty wire will yield results in 28. So after that, we are definitely looking at a better EBITDA.
Okay, so what should that margin number be, Pranav? What should that margin number be?
So in FY26 and 27, let's say
give us that journey.
Percentage is decreasing a little bit in FY26, especially because of the hit that we are taking in our margin to grab higher market share. But FY28, I think we will be back to this margin or a little higher than this.
Is debt and cash flow a concern, Pranav? Sorry, last question.
So we are actually doing a lot. We are actually doing a lot to improve cash flows and better ROCs within this year and next year. So FY26, 27, although with a reduced margin, we will try to bring out cash flows in a better way. We are looking at a lot of cash flow positivity from the first quarter itself.
So why have receivables increased? Why have receivables increased, Pranav, this time around? Why is inventory high, receivables high? Why is that happening?
So that has happened because of a consolidation that happened within the group last year. When we went public, we said that we'll merge all our other companies within this Bansal Wire Industries, and that is what has happened last year, because of which our number have also increased by about 50% in sales. Now, to do that, we need to carry a lot of inventory, and we need to have a good amount of debtors, which is increased. But of course, we will try to normalize this within this year.
All right. Thank you, Pranav, for being so patient and answering all of those questions, and fairly quick as well. That was good. Thanks, Pranav, for coming in and speaking with us, giving our viewers that perspective. Viewers, completely out of time on this edition of KYC. Thank you so much for joining. Stay tuned to NDTV Profit. More action on the other side.